Gold is a monetary metal. Gold is money. I'm not the first one to say that. So, but it's proven itself over and over again to be a monetary metal. It's pure money, honest money, real money. So it's not a base metal and it's not energy. It's money, like I said. So I'm the only commodity I'm long right now is gold. And you know how, gold has outperformed the S&P for 25 years. It's a quarter century. It's not an idiosyncratic thing. It's not only outperformed the S&P, it's done so with much less risk.
In today's news recap, analyst predicts silver prices could reach $200, driven by demand for new EV battery technology. A financial expert with over a decade of experience in commodities markets has predicted that silver could reach $200 per ounce in the next 10 to 15 years, riding the wave of increased demand for a new EV battery technology developed by Samsung. According to Bambro, the new batteries may require 1 kilo of silver per car, driving silver usage sky high. Bambro believes that the precious metal will be able to reach $200 per ounce prices, supported by the emergence of a revolutionary new electric vehicle battery technology that uses silver in its structure. The new solid-state batteries developed by Samsung feature a silver carbon composite layer for the anode, allowing them to have an increased life, dramatically reduced charging times, and larger operating longevity. According to his estimates, each battery cell might require up to 5 grams of silver, putting the whole requirement for an average car battery at 1 kilograms. Bambro assesses that if only 20% of the yearly global car market adopts this kind of battery, 16 million EVs, it would increase silver demand sky high. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hit the like button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Gold is a monetary metal. Gold is money. I'm not the first one to say that. So, but it's proven itself over and over again to be a monetary metal. It's pure money, honest money, real money. So it's not a base metal and it's not energy. It's money, like I said. So I'm the only commodity I'm long right now is gold. And you know how, gold has outperformed the S&P for 25 years. It's a quarter century. It's not an idiosyncratic thing. It's not only outperformed the S&P, it's done so with much less risk. Its risk adjusted returns are through the roof. Sharp ratios, very high. So if you look at past recessions, the worst place you could possibly be in is base metals and energy. They get wiped out, both the commodities and the equities. And even gold, and this is very truncated. So gold stocks are stocks, so they could get wiped out while gold is doing okay. But when, like you said, when push comes to shove, anything that's not nailed down that can be sold gets sold in a liquidity crisis. Now we're nowhere near that yet. Nowhere near that yet. So I'm staying with sector 2, which is disinflation, which is have falling nominal rates and falling real rates, is really good for gold. Now, the nominal part of that, well, you see the short-term nominal is falling, but long-term is rising. So you're losing that part of it. But you still have, you have global chaos and conflagrations all over the world. You've got a budget that's just out of control. If you look at both spending plans from both potential candidates, they're just, there's no hard money, balanced budget candidate out there. So, and gold loves runaway debt and deficits, because what do you have to do? You have to print the money to buy those. So we print money, you buy debt, prices go up, yields are capped, but the real interest rate plummets because you have to subtract inflation from your interest rate repression regime. Yep. Gold loves that. Gold loves that. So I'm sticking with gold for now. And that's it. But like you said, And like I alluded to before, on the other side of this, which could be brutal. I mean, yeah, you can time the market if you understand the rate of change of inflation. And the rate of change of inflation could skyrocket, but not now. I mean, the Fed isn't at zero. Real interest rates, if you look at the real Fed funds right now is still positive, like 200 basis points. If the Fed took interest rates to zero and they started quantitative easing and we started sending checks out to consumers, I would sell every single bond that I owned. I would short the bond market. I would sell anything that's even looks like a bond. But right now they're working, so stick with it. Because the Fed and Treasury haven't done that yet. But they will, and that's my real fear. They will do that. And then when they change, or when when the market is anticipating that change to occur, but here's the news flash for you, or maybe not. The market is based on inside information. So I mean, the people who know what's going to happen will react ahead of time. And that's what they do. And my model picks up on that behavior.
In today's news recap, a guide to the gold-silver ratio. The gold-silver ratio measures the relative value of gold to silver, but why is the measure useful for investors? The gold-silver ratio has long been considered an important metric to gauge the best time to invest in precious metals. If you monitor gold prices, you'll know that although the yellow metal is usually seen as a stable investment, its price has recently surged. Thanks to central banks buying up the commodity and its diverse use in various industries like nanotechnology and cancer therapy, silver is traditionally more of a volatile investment, and after years in decline, it might just be set to make its way back to form. Whether you are new to precious metal investing or want to diversify your portfolio, it's useful to know the relative value of silver against gold, as it can affect investor sentiment, help understand economic trends, offer a hedge against inflation, and influence your investment strategy. The gold-silver ratio is the oldest tracked exchange rate that is still in use, and it is a guidepost for investment decisions, be it inflation, deflation, market crashes, and broader economic trends. The higher the ratio, the more expensive gold is relative to silver. While there's no definitive benchmark for the ratio, assessing the current gold-silver ratio against its average in recent years can be one factor that investors can use when making an assessment on when to buy or to swap holdings of either metal. Do next. Divide the current ratio by the average, and you can calculate whether one metal looks too expensive or the other too cheap based on average performance. If the gold-silver ratio was still based on the availability of the natural supply of the metals, it would stand at 15-1. Estimates suggest there is roughly 15 times more silver in the Earth's crust than gold. But gold has been seen for years as a store of value, a hedge against inflation, and the gap between gold and silver is ever mounting. In April 2020, the gold-silver ratio reached a record 125-1 as a response to the onset of the COVID pandemic. Today, the ratio has dropped from those heights and is now sitting around 84 ounces of silver to 1 ounce of gold. Now, we'll show you the best clips of the latest interview, but first, like, subscribe, and hit that notification bell so you don't miss any recaps. Enjoy the episode.
Well, we haven't triggered it yet. I mean, we're long this market, and we have a very solid year performance-wise. But there are things you can look at, and I look myopically at credit spreads and financial conditions of highly stochastic things in my model that let me know when I should be worried. So I'll say that. Now, the question you asked me is, when do we know this is going to happen? Is that the basis of your question?
It's one, yeah, and then the secondary.
And then how bad? When do we know, and how bad does it get?
Yeah.
Okay. So when we know, I answered the first part of the question is when my model, the highly stochastic parts of my model, components of my model, when they trigger me to get defensive, will be when credit spreads start to blow out and I'll get back to that in a second, and financial
Okay.
condition.
Yeah.
So how deep should this be? The natural force of things, I like to say the gravitational forces of deflation are extremely prevalent. It's like a black hole. So in other words, you have to have a lot of artificial stimuli. And by that, I mean monetary infusions, monetary injections to stop the gravitational forces from taking hold. So for instance, home prices need to drop by 40% to put them in historical line, not a reversion to the mean, not below that, just to revert to the mean. Home prices have to drop by 40%. Now, Jay, I probably don't have to tell you what would happen to the banking system if the value of mortgage-backed securities dropped by 40%. I'm talking about the shadow banking system and the commercial banking system. They would be wiped out. There wouldn't be a solvent pension plan or a solvent hedge fund on the planet practically. So that is where they should go. And coincidentally, maybe not so much, stock prices need to drop by 40%, or closer to 45% now, just to bring them back to 100% of GDP. Assuming GDP doesn't drop, if home prices and stock prices don't drop, and the credit bubble doesn't, and that's a bad assumption. So you're looking at a massive wipeout of the top 20% of that cohort of consumers who have been keeping the whole economy going. It's the top 20% that are keeping the spending going. I mean, the people that are buying houses for cash in Naples, Florida, where I live. That's the cohort that's keeping the economy going. Buying Bentleys for cash.
Right.
That's what's keeping the economy going forward. When you take 40% off of their assets, home prices, and 20, I read a statistic that, for example, about a year ago, 68% of all home purchases were purchased by investors. Investors own in aggregate about 25% of all homes. Now, you have a portfolio. If you're a corporation on Wall Street and you own a profile of thousands of homes, or even if you're an average Joe or above average Joe with 5 houses in your portfolio, and you've got a huge gain of 100% or so in those houses, and you can't rent them out anymore because people are losing their job and the cash flow dries up, and you say, I'm going to put 4 houses. I can't live in 5. Don't live in 1 at a time. I'm going to put 4 houses on the market. That's what's going to happen in droves, and home prices could crash. And home prices crash, your net worth disappears especially the top 20%. So you could have a severe the natural course of things is to have the gravitational forces of deflation reset all of these imbalances in the economy. Mm-hmm. Now, the Fed, and I got to tell you, there's no way Jerome Powell, I don't care what you think he is, a conservative, a Democrat, a free money guy, or a hard money guy, Paul Volcker, or is he, Miller? I don't know. I don't know how you feel about him. I can tell you the facts of how he acts. Okay. He is the one, I think he came in 2018. He dropped interest rates pre-COVID pretty substantially. So 2019, he was cutting interest rates before the virus was even known. And he kept buying mortgage-backed securities in 2022, in early 2022, after the COVID wasn't a problem and home prices were through the roof. And he's the one who reduced interest rates in emergency measure by 50 basis points last week.
Right.
Even though inflation, headline 2.5%, core 3.2%, is way above target, even though the unemployment rate is 4.2% when historically it's 5.7%, even though we have massive asset bubbles, credit spreads are tight, financial conditions easy, why is he cutting by emergency? I mean, this gentleman has proven through inculcation to Wall Street and me that he is there. So, what's your point? What's my point? My point is that the Fed is not going to go quietly into the good night and just let the deflation fix everything. He's not going to do it. He's going to cut rates to zero, and he's going to go back into ZERP, and he's going to join hands with Janet Yellen and have some kind of monetization of helicopter money if they can get it through Congress. That's what's going to happen. And here's and I'll wrap up with this. I'll wrap up the answer to your question with this. Every other time they've done that, it's been successful in reflating asset prices because the Fed has been able to take down short-term interest rates. They control money markets. They can do that. They absolutely can control the interbank lending rate. But they don't control directly long-term interest rates. That's what they do not control. That's a function of credit quality of the United States government and inflation. And every other time in the past, they've gone through this. They've managed to successfully bring down both short-term and long-term rates. What if this time, precisely because we have $1 trillion in interest payments on the debt, precisely because we have $36 trillion in debt, precisely because we have 125% debt to GDP, precisely because we have not vanquished inflation, and we're going down the dangerous path of trying to reflate the economy when we haven't fixed the level of prices by any means whatsoever. What if interest rates on the long end rise? And that's what I think is not only possible, but probable and likely. And if that's the case, if that's the case, you don't fix anything, because long-term interest rates are what mortgages are based off, and if you have a spike in long-term interest rates, it's going to be detrimental to the stock market too. So in other words, I'm saying there might not be anything the Fed can really do. Have you noticed, Jay, that since the Fed cut interest rates by 50 basis points, the long end of the bond market, the yield, has gone up and prices have gone down? Have you noticed that?
What do you think of Pento's take? Is he spot on? Are you still bullish on the market, or on the contrary, you're leaning towards a bearish side? Post in the comments section your honest opinion and share this video with someone who owns gold. Now watch this video right here because it's a perfect fit for you. I'll see you on the other side.